Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which is relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of which is relied upon as any form of advice at all, is just general in nature only. Last week we talked about differentials between central banks, and that is still very much front and center in terms of how we are thinking and where you need to be looking. But we also need to continue to highlight that they're, at the moment, the FOMC, they're hatching hawks like no tomorrow. And I find that kind of a little bit ironic to say because it's about who we're going to talk about. Lael Brainard has been a very moderate voice out there, very, very dovish over the last couple of years. And to see her talk last week, she must have been squirming inside to sit there and say such hawkish things so strongly. It's around the balance sheet, and I think we need to concentrate on that. The expectation now is that not only are they going to shrink the balance sheet, they're going to do it rapidly and hard. The expectation is $95 billion a month is going to be unwound out of the bulging Fed balance sheet, which is over $7 trillion. That's almost double what we saw last time when they started unwinding. And that in itself is something that's quite interesting to see how fast and the speed of which they want to unwind that sheet. And she is the one that's advocating for that. You then look at also what they're talking about from her perspective. Rate rises are as expected and was forecasted in the March numbers. Then you've got someone like Jamie Bullard, who is forever the hawk that we know that he is. But he reckons they need to raise rates by 300 basis points come December. That would mean that the mortgage rates in the States will be in the 6 handles for most, and some would even see mid 7% mortgage rates on their 30-year mortgage. That's pretty incredible. That's one way to slow things down. It certainly wouldn't control inflation. The question would be, how much would it control growth? And what would that do to growth? Would it crash it? Probably would. Interesting enough though, all of that put together, US dollar is clearly strength. That is a clear sign, along with real yields. So again, the one that's the standout is dollar yen. Dollar yen is still trading fairly fundamentally, and why it's probably the one to continue to watch. It's at 124, which is about what you would expect, and it's continuing just to edge up as you see those real yields go. It has been the story of the last year. There's no doubt, going from 104 to where we are now. That is quite a movement that's gone in the Japanese yen, and the carry trade is very, very strong. You then look at euro dollar. It's back below 110. It's ranging between 108, 109. The only way you could see that changing is if the ECB was to break out of where it is and go early and start raising rates. Not an impossibility, but it's certainly unlikely, and the market is pricing that way. The one to then highlights the Aussie dollar. The Aussie dollar did very, very well and is doing very, very well, but every other currency but looking at the USD. It did jump up to 76 cents at the back of the RBA, signaling that it is now clearing the decks to raise rates. But by the end of the week, that was gone, and it was back below 75 cents and heading lower still. The commodity story is helping it, but it is there to show you as a barometer that at the moment, everything is still leading to the USD. Don't know how long it's sustainable for, but that is what is going on.